The market has seen a sell-off as speculators lowered their bullish wagers due to renewed fears about the global economy and oil demand, which was prompted by the pessimistic stance of oil traders in recent weeks. The market's positive attitude from September, when it was all about the OPEC Plus production cutbacks, was replaced by pessimistic sentiment in late October and early November when worries about a supply shortage were swapped out for fresh concerns about declining demand. Consequently, last week saw a 4-month low in the bullish positioning of fund managers in the two most traded petroleum futures contracts, Brent and WTI. The biggest producer and head of OPEC, Saudi Arabia, maintains that demand is still strong and that the recent drop in oil prices from $90 to $80 per barrel Brent was caused by overblown worries about supply. Saudi Arabia may decide to postpone its additional production cut of 1 million barrels per day, BPD, until 2024, or at least partially, due to the excessive accumulation of bearish positions. The agreed upon 300,000 BPD export decrease from Russia and the voluntary drop from the kingdom are scheduled to expire at the end of 2023. However, both OPEC Plus producers could try to extend the cutbacks in order to attempt another price run-up if oil drops to $80. An extension of the additional production restrictions may be in order given the historically weaker demand for oil in the first quarter of every year. Data from exchanges collated by Reuters market analyst John Kemp shows that traders have now been net sellers of the 6 most significant petroleum futures contracts in 5 of the last 6 weeks. In the week leading up to November 7th, the total net long in WTI and Brent, the difference between bullish and bearish bets, fell to a 4-month low at 312,000 contracts, according to Ole Hansen, head of commodity strategy at Saxo Bank. Since September, when attention turned to tight markets driven by Saudi production restrictions peaked before concerns about demand took over, the net long position in the 2 most traded contracts has now dropped by 44%, according to Hansen. It is reasonable to assume positions have been cut even more, perhaps laying the groundwork for another bounce, especially when WTI and Brent hit support below $75 and $80, respectively, given the rapid price decline that followed November 7th, Hansen said. Although traders are still more pessimistic about oil, Saudi Arabia and OPEC claim that the market's decline was overblown and that demand, including record high demand in China, is strong. Notwithstanding the difficulties, the economy is still doing quite well, according to OPEC Secretary General Haytham Al-Ghais last week. Less than 3 weeks before the OPEC Plus alliance's oil producer ministers gather for a critical production strategy decision on November 25th to 26th, Al-Ghais voiced optimism about the world's oil demand. Then, this week, OPEC dismissed the latest negative market mood as overblown and stated that the fundamentals of the oil market remain solid, with Chinese crude imports expected to rise to a new annual high in 2023. OPEC stated in its monthly report for November that despite the erroneous negative sentiment in the market regarding China's oil demand performance and the global oil market in general, the most recent data shows Chinese crude imports increased to 11.4 million barrels per day in October and are still on track to reach a new annual record high for this year at roughly the same level. Prince Abdulaziz bin Salman, the energy minister of Saudi Arabia, stated last week that the country's oil demand is still strong and attributed the recent decline in oil prices to speculators. Even the International Energy Agency, IEA, revised up its estimates for oil demand growth in 2023 and 2024, saying on Tuesday that world oil demand continues to exceed expectations, even though this more bearish mood may be justified. The ING strategists Warren Patterson and Eva Manthi commented on the recent fluctuations in oil prices in a note on Tuesday, saying, "We believe the scale of the move lower in recent weeks has been extreme. The market is likely to continue in deficit for the duration of the year, despite the fact that fundamentals are still supportive even though they may not be as positive as first believed. If the Saudis carry over their additional voluntary supply cuts, the surplus we see early next year might even be eliminated." Following the decline on Wednesday, crude oil prices were still low in morning trade in Asia today. The announcement that OPEC Plus is postponing its summit from this Sunday to next Thursday knocked prices down yesterday. The recent EIA oil inventory report, which revealed a sizable gain in U.S. crude supplies, further contributed to the downward pressure on oil prices. Earlier today, West Texas Intermediate and Brent crude fell more than 1%. According to Reuters, there seemed to be a debate among OPEC members on the output levels the group was striving for. According to the article, which cited anonymous cartel insiders, the conflict was centered on African members. According to analysts, Angola, Nigeria, and the Congo may wish to increase their production limits beyond what was decided upon during a June summit. With Saudi Arabia willingly reducing production by 1 million barrels per day and then extending this pledge until the end of this year, OPEC Plus decided to limit output in June. Ever since, Saudi Arabia has voiced its displeasure with other OPEC members' production levels. According to a note from RBC Capital Markets' Helena Croft, which was published by Reuters, at that meeting, OPEC squared the books on increasing UAE's quota by reducing the targets for the African nations that were underperforming their required production numbers. Warren Patterson of ING observed that disagreements among OPEC members would increase price volatility, but it's still unclear how these disagreements would impact Saudi Arabia's output plans or the cartel's policies, according to a Bloomberg story earlier today. According to Citigroup analysts, there won't be any surprises at the OPEC meeting, and Saudi Arabia is probably going to continue its voluntary reduction of 1 million barrels of oil output for an additional month. The analysts projected that the remaining members of OPEC will likely adhere to their existing quotas. Oil prices were already under pressure to decline earlier this week due to fears that OPEC Plus might expand its cuts at its next meeting. However, the meeting's postponement has raised additional worries about the growing discord among the cartel's members. Most analysts had anticipated that the Saudis would prolong the voluntary output cutbacks through 2024 prior to the postponed meeting. If OPEC Plus producers do not end their production cutbacks in 2024, oil prices may reach $107 per barrel the following year, according to Goldman Sachs, who also noted that a triple-digit price is not the bank's base case scenario. Saudi Arabia announced on Tuesday that it would extend its 1 million barrels per day (BPD) reduction through December 2023. According to Saudi Arabia, this action strengthens the precautionary efforts made by OPEC Plus countries with the aim of supporting the stability and balance of oil markets. The Saudis will pump 9 million BPD until the end of the year due to the cuts, which will be reviewed each month to determine whether to further reduce the reduction or increase output based on the situation of the market. Additionally, Russia continued its 300,000 BPD export cut into December with the ability to evaluate each month and may further reduce exports or boost supply, depending on the state of the market. Oil prices soared as a result of Saudi Arabia's actions, with Brent exceeding $90 and WTI getting close to the $88 threshold. The extended cutbacks enhance the upside risks for oil prices, according to a note from Goldman Sachs Commodities Research published after the news. Consider a positive scenario, according to Goldman's analysts, in which OPEC Plus maintains the 2023 production cuts fully in place through end 2024 and Saudi Arabia only gradually increases production. The Wall Street Bank predicted that this bullish scenario might raise oil prices to $107 per barrel in December 2024, but it stressed that this is not their most likely outcome. This is not our baseline view because, according to Goldman's note, which was picked up by Reuters, we believe the producer group is unlikely to pursue prices significantly above $100 barrel per day given the robust supply and investment response to the 2022 energy crisis, our high-frequency tracking of U.S. shale, and the political significance of U.S. gasoline prices. Other analysts claim that the prolonged production cuts from the two OPEC Plus leaders, Saudi Arabia and Russia, do not justify an oil price of $100 per barrel, particularly in light of ongoing concerns about the economy and oil demand. Goldman Sachs believes oil prices could hit $107 next year if Russia and Saudi Arabia maintain their production cuts. What are your thoughts on Saudi Arabia and OPEC Plus? Let me know down below. If you want to continue to learn about business investing and financial education, we have got this video waiting on the screen for you to check out. Don't forget to give this video a like and subscribe for more videos like this. Thank you so much for watching and I'll see you in the next one.